I want to talk to you about investor focus, about trying to put yourself in the shoes of an investor, because this is something that comes up in the SBR exam in question 4. It's a very relevant skill to be able to communicate to investors as to what is going on in the financial statements. And so this is something which is regularly examined. And the idea of this short video is to try and give you an insight and support on this area. Because when I read the examiner's reports, I'm aware this is a question which is not normally well done. Now, maybe that's down to time management, maybe that's down to knowledge. Well, let's see if we can address some of the knowledge issue. My name is Tom Clendon, and I'm passionate about helping students pass SBR and keeping it simple. When we talk about putting ourselves in the shoes of the investor, we have to think who they are. And the conceptual framework identifies that the providers of equity finance are the primary users of the financial statements. They are our audience. They are the owners of the business. They've put their money in, their capital, they've invested in the business. And we have a stewardship responsibility to tell them useful information to help them understand how their money is working for them. But when we talk about investors, we're also talking about those who lend money to the company. Investors who have subscribed to bonds, subscribed to debentures that have been issued by the company. Investors who, so far as the company are concerned, are long-term liabilities rather than shareholders. So there are these two types of investors, equity and debt. Let's think about equity first. They're the most important. Let's think about what their information needs are, what they want to know, which I think, crudely speaking, cutting to the chase, is profit. They've put their money in the business and they want to know what the return is going to be, what the profit is. But investors are smart and they think long term, and therefore they're also interested in the sustainability of the business. Sustainability is now embedded within the SBR syllabus, and we can't really talk about investor needs without thinking about the long-term survival of the business. Equity shareholders are also interested in the value of the business and therefore the value of their shares. And one way of valuing their shares is to look at the dividend valuation model. Not that you're going to have to apply that model, but you've got to be aware that dividends are important to investors. They want to know about dividends, partly because they want the cash. Are they going to get the dividend? But also it feeds into the value of the business. Now, dividends are paid in cash and they're paid out of profits. So equity shareholders will want this information because they're going to be making decisions. They're going to be making decisions, and we need to think about what decisions equity investors are going to make. Well, fundamentally, it's about whether they're going to buy more shares, maybe subscribe to a rights issue, whether they're going to sell their shares, or whether they simply hold their shares. They've also got decisions to make about appointing directors, appointing auditors, voting at the AGM. It's the equity shareholders who decide who the management of the company is. Now, debt. Let's think about those investors who have lent money to the company. Let's put ourselves in their shoes and think about their information needs. Now, equity shareholders are obsessed with profit, but I don't think that's the same extent for debt, because they don't participate in that share of profit. They're interested in getting their money back. Will their interest be paid? Yeah. Will their principal be repaid? Will the business still be going? What's the value of any security? Is the business meeting its debt covenants? So they're interested in cash flow. They're interested in knowing about the interest cover and whether the agreements, the debt covenants that have been put in place, whether they are going to be honoured. Value of security I've mentioned, because some debenture holders will have a charge on certain assets of the company. And to that extent, they will be less interested in what those assets cost and more interested in what those assets could be sold for. Yeah, investors who are debt investors who've invested in the debts of the company will want to think about the fair value of the assets rather than the historical cost of the assets. So let's think about the decisions that an investor who is a debt holder has got to make. Well, basically, do they foreclose? Do they call in the loan? Yeah, or do they lend more money? Or do they effectively simply hold? They haven't got a vote at the AGM. They're more interested in cash flow, I would suggest, than profit. Okay? So, those are the decisions. I want to be controversial. I want to throw a pebble in the pond and talk to you about whether or not financial statements meet all of the information needs of the investor. And I'm going to suggest that effectively they don't. The financial statements that we present to shareholders, to debt providers of capital, are past orientated. Last year's profit, last year's cash. And actually, what investors really want to know is what's going to happen in the future. So the fact that we give them past information, yes, it's more reliable, but arguably it's less relevant. And it's short term. It's short term and it's profit orientated. And we can talk about other disclosures in a minute. But short term, the business cycle of a business may be 20 years. If you're dealing with a power station, if you're dealing with wind farms, there could be a payback period of 20 years. And yet we've got this arbitrary little 12-month financial reporting cycle when that doesn't fit in with a longer term investment strategy. So there are problems. There are problems. It is true that the statement of financial position, the balance sheet, doesn't measure the value of the business. It doesn't include inherent goodwill. It doesn't include brands that you've generated. It just doesn't. And some investors are confused by this. We have to be aware and be able to educate investors that financial statements operate a mixed measurement system. So some assets are at cost and some assets are at value. So in my opinion, financial statements don't meet all the information needs. But we've got to bear in mind that financial statements are addressing this. The regulators are addressing this through disclosures. And I don't just mean related parties and segmental disclosures. I mean things like integrated reports, which begin to shift away from the obsession of financial capital and start thinking about other forms of capital, natural capital, human capital, etc. So these can be useful for long-term investors, sophisticated investors. There's a lot of regulation out there now relating to sustainability reports. Yeah, you've got there, remember, IFRS 1, IFRS S1, the general requirements for disclosure of sustainability standards. Yeah, that's very mainstream these days. That's examined on a regular basis. And I want to spend a minute or two talking to you about alternative performance measures. I mean, these are very entity specific, very useful for users. You might have an airline industry, for example, and an airline industry could give alternative performance measures around seat occupancy or safety record or delays, because these are measures of how a well-run airline business would want to publish statistics, because these are alternative performance measures because there's no specific accounting standard telling you to publish them. Now, I think we've got to be skeptical about alternative performance measures. They've got to be taken with a pinch of salt, because they may not be a faithful representation. They may not be reliable because by definition, there isn't an accounting standard underpinning it. So you've got to exercise a little bit of judgment. But given the prevalence and usefulness of alternative performance measures, IFRS 18, Presentation and Disclosure in Financial Statements, has introduced disclosure requirements in relation to a narrowly defined set of alternative performance measures, which are known as Management Defined Performance Measures, MPM. And these additional disclosures have got to be welcomed. IFRS 18 has got to be welcomed because the regulation will enhance the usefulness, will enhance the comparability of these narrowly defined MPMs. Now, the disclosures that are required basically include a description of the aspect of financial performance that the MPM communicates, along with an explanation as to why management believe that that particular MPM provides useful information. We also need to have disclosures about how it's calculated and how it reconciles back to the most directly comparable subtotal required by IFRS 18 or any other standard. And we also need to have a communication about the tax effects. Now, talking of tax effects, what you could be asked in question 4 is something like this. Explain to an investor why the tax charge in the P&L is a different number to the tax paid in the cash flow. You might want to pause the video here. You might want to think of that answer. Now, I've got two ideas. I've got two basic reasons. The first is the matching concept. The first is to reflect the idea that tax is paid in arrears. The tax that you're paying this year is fundamentally the tax assessment on last year's profit. So the two numbers are always going to be different. I suppose accruals or the matching concept also underpins my second point. Deferred tax, ISA 12. Yeah, that is not a cash flow. The taxation charge, if there are taxable temporary differences, may be higher. There will be an additional expense which hasn't been paid for this year. So those are two particular reasons why the tax paid in the cash flow is different from the tax expense that is charged in the profit and loss account. Let me give you another interesting potential example of something that could come up in question 4. Explain to an investor why the expense of interest in the profit and loss account is a different number to the interest paid in the cash flow. Now, again, when I begin to think about this answer, I think of the accruals concept, because what the profit and loss account is doing is making sure that the cost of borrowing money is effectively spread over the accounting periods that benefit from that loan, whereas the cash flow simply represents the interest that you've paid. Now, what you should be aware of is that the interest expense that we're charging in the P&L is much more than the interest that we've paid, because it could include issue costs, which are paid up front. It could include the discount on the issue, which is money we kind of don't get at the beginning, but we have to pay back at the end, and the premium on redemption. So there are good, sound reasons why the interest that we pay is often a smaller number than the interest expense, because the interest expense will include issue costs, premium on redemptions, etc. But there are other reasons. I mean, on a simple level, the calculation of the interest expense in the P&L is based on the effective rate. Whereas if you've got a bond, if you've got a debenture, you're calculating the cash that you pay based on the nominal value. Yeah, the coupon rate on the nominal value. And you can even have zero coupon bonds, can't you? Where no interest is paid, but there's a balloon payment at the end. But the finance cost must reflect the matching concept. I'll leave you with a third. There's a bit of financial instruments going on here. I'm going to introduce a bit of ISA 23 borrowing costs, because not all interest that you actually pay goes directly through the profit and loss account as an interest expense. It may be capitalized, because you may have incurred the interest because you're building an asset, constructing an asset, a qualifying asset, and during the period of construction, the interest expense is capitalized rather than directly written off to the profit and loss account. So investor focus is very holistic. You're kind of revisiting sometimes accounting standards that you know and looking upon them in a new light, having to explain them. What to do next? Keep swimming. Yeah, keep going. Keep thinking. All right? It's important. It's important. This short video hasn't told you everything you need to know about question 4 and investor focus. It's touched on sustainability. It's touched on IFRS 18. Maybe you need to go and do some more research and read some more articles. Luckily, that's relatively straightforward. You've got access to the study hub. Everybody's got access to the study hub. My name is Tom Clendon, and I'm still passionate about keeping it simple and helping students pass strategic business reporting. Thank you very much for listening to the end of this video. If you've liked it, why not like it? Yeah? Thank you very much indeed.